Welcome back. This is Corporate Radar. So let's get straight to our next management. Tata Communications, that's a stock in focus. For quarter one, their data revenue saw a 20% growth on a year-on-year basis, while the digital portfolio revenue also saw a 51% growth. Their margins are also improving on a sequential basis. To understand what's the way ahead, we're joined by Mr. Lakshminarayanan, the MD and CEO of Tata Communications. Hi, sir. Good morning, and always good to see you in. We have the overall growth picture. That's at around 20% odd, but you had done some inorganic growth. So what was the organic growth for the past quarter?
Yeah, so we don't really call out the organic growth. The reason being there are two acquisitions that we did last year. One of them being Switch, which we acquired in May last year. So it's nearly 1 year, one full year is already over. And right from the day one of the acquisition, we have been managing the two teams as one single team with one single leader. Similarly, on Kaleyra, which we closed the deal in October, right on day one, we announced an integrated management team of Kaleyra. And Digo, a product that we launched 2 years ago, was doing very well in the market. We essentially brought Digo and this together with single teams. So we really can't distinguish the Digo growth from a Kaleyra growth, because in a go-to-market, we integrated the teams from day one. But having said that, there are a couple of more point-worthy data points to note in our digital portfolio. Obviously, now the customer interaction suite and therefore the entire collaboration and customer interaction suite is a very large part of our digital portfolio. The cloud and security portfolio has grown very well. Our media portfolio has shown a very significant jump on QoQ as well as on year-on-year, on the back of events pick up in the last quarter. And also, we have seen a fairly significant growth in our connected solutions portfolio, particularly Move. We have seen a good growth both in the MNO segment that we operate, as well as in the automotive OEM segment that we operate. So these are very notable callouts from if you will, the organic portfolio, if you will.
So, but just to kind of get that point, you don't reveal the breakup, the numbers, but the reason we are asking is that there seems to be some concern that while the inorganic moves that you're making, those are really delivering growth, there's some confusion about what's happening to the organic business and the organic revenue. So going forward, can you...
Yeah. Sorry, I think that's the reason, sorry to interrupt, but that's the reason why I'm calling out individually. So the media portfolio Switch is already 1 year, right? So give or take 1 month, and it's been operating as one. And this quarter, we have shown a good QoQ growth of 9% and year-on-year growth as well. On the only portfolio there has been a blip is in the next-gen connectivity, and that is a customer-specific issue that we saw a blip in this quarter. But last year, we grew the next-gen connectivity very well. The ISO Multi-Cloud Connect product that we launched has seen nearly 40-45% growth year-on-year. And Move platform has shown growth. So I think overall, in cloud and security, we have seen a double-digit growth. So these are all the other portfolios in our digital, which was not influenced that much by inorganic acquisition. So that's the point I wanted to make.
Got it. So basically, organic growth is also, chugging along. No reason to worry over there. Got that point. Let's talk about the data growth.
Sure.
Yeah, sorry, yes.
No, I think, they are chugging along, as you said. I think we have to be also very conscious of the macro environment. We all operate in the same space as other players are operating, and people have been calling out the slowness in the macro environment. And that applies equally to us. The only thing I would call out is, despite that, we have achieved good growth and we've been able to give an uptick in our margins, which I think is a commendable performance by our teams.
Sure, sure. So let's just talk about the data growth. The revenue growth there is about 20%. In the last 2 quarters, it was a lot hotter, almost 26, 27%, 28%, I think, as well. So what is, either those quarters were a bit of an aberration and a lucky blip, or a good, blip in terms of a good quarter. What is a more sustainable run rate? And you also mentioned that the environment has been sluggish and challenging. Does it continue to remain so? And on data in specific, what is the kind of growth you can guide for?
We don't want to give any guidance and start a new practice, but I think the environment is still cautious. I think the environment in the US with the elections and expected rate cuts, not knowing when that will happen. So there are these environmental factors. But having said that, our international markets have grown very well. I think in our digital portfolio, the way I see it is, the four pillars of our digital fabric: the network fabric and the cloud and security fabric. So these two fabrics are, I would say, somewhat immune to the macro, and I think we expect that because people look at more cost efficiencies, more global contracts. How can we consolidate global vendors into that? So I think those two, regardless of the macro, should do very well. The customer interaction portfolio is more discretionary because it's more dependent on marketing spend. And so there are two types of interactions with customers. One is on marketing and improving the customer experience on after-sales service. And the other is more about authentication and so on. So that is somewhat dependent on the macro and somewhat cyclical. The IoT fabric, again, is somewhat discretionary because people would want to invest in delivering connected solutions and delivering better connected products to deliver better experience. And that would come under the discretionary spend. So that's probably how you would look at the impact of the macro on our portfolio.
Okay, all right, Mr. Lakshminarayanan, let's ease you out a little bit. We're not getting too many numbers from you, but let's compliment you on the margins. You have said that in the past that gradually you see margins move towards that band of 23 to 25%. And on a sequential basis, there is some improvement. So tell us for this year, how much, better can it get from what you've delivered in the first quarter? On an average for FY25, what can it be? And by when do you get to that band, 23 to 25?
So firstly, on the 23 to 25%, we said that that's our medium-term target, and we would get there in a couple of years' time. This quarter, we are very, very pleased to see the uptick from the exit of last quarter of 18.5% to 20%. And we anticipate that we will retain at this level and gradually start to improve in the coming future quarters. So because at the increase in margins are on the back of a lot of activity that is going on to bring the benefits of synergies and the programs that we are running inside the company to deliver better operating leverage. But having said that, we're also investing even further in developing more within this platform. So Kaleyra, for example, as a result of the acquisition, there are some cost synergies that we are working on, but we are also investing in expanding the product portfolio to move beyond SMS to WhatsApp and other channels, and we are building out the software platforms on top. So those investments will continue, and therefore, we would gradually improve the margins. Our focus is to get to the 23-25% in a couple of years' time.
So FY26?
You can say that, yes.
Okay, all right. You also said that you're looking at doubling your data revenue by FY27. The street believes that looks very, very aggressive without any more M&A. So that guidance that you've given of doubling it, does it include some M&A? And if yes, should we hear about something in this fiscal itself?
No, firstly, I just want to correct, it's not a guidance. We said that is our goal, and we set ourselves a fairly ambitious target. So looking back at, our performance over the last 5 years, it's been largely focused on getting our balance sheet right. It's been getting the margin profile right, the operating model right. And having done that, the choices was, we stay there and deliver low growth but high margin, or deliver a faster growth. And in order to deliver a faster growth, and also to become a lot more relevant in the digital journeys of the customers, we had to expand our portfolio, and we have to invest in strengthening our products and platforms. That is exactly what we said we would do, and that is what we've been doing. And last year, we have invested over $600 million in all the capability enhancements, organically and inorganically. So that's a picture that I wanted to paint, to let you know that we are investing for growth, right? And that's the motion that we're now. And because that we've said that ambition is that, and we are investing, we are already beginning to see that our relevance with our customers are increasing. And it depends on when the macro conditions will improve. We are very well prepared and set up in order for us to achieve the growth targets that we've said we will.
Okay. All right, sir. We will leave it on that note for today. Thank you very much for joining in and giving us some perspective on your business.